$172.37. That was Boeing's share price, April 23rd, 2025. But here's what really caught my eye. The 52-week range.
Huge range.
Yeah, massive, like almost $129 on the low end, up to nearly $197. That kind of swing.
Yeah.
It just makes you wonder, what is really driving things at Boeing?
Exactly. And that's what we're going to dig into today.
We are. You, our listener, sent over some fantastic research, and our goal here is pretty straightforward. Cut through the noise and get to the core of what's shaping Boeing right now. Think of it as your shortcut to being really informed.
Absolutely. We're going layer by layer. The business itself, who's running the show, their financial shape, market buzz, who owns the stock, and importantly, the risks they're staring down.
By the end, you should have a much, much clearer picture of what really matters for Boeing today.
Let's do it.
Okay, first things first, Chapter 1, Understanding the Business. Most folks know Boeing, global aerospace leader, but let's break it down. They design, build, and service, well, pretty much everything that flies, plus defense and space tech.
Right. And it falls into three main buckets.
Yeah.
BCA, that's Boeing commercial airplanes. Then BDS Defense, Space and Security. And BGS Global Services.
And the Q1 2025 results, they tell a story. Total revenue was, what, $19.5 billion?
Yep, 19.5.
But here's the kicker. BCA, the big commercial plane division, $8.1 billion in revenue, but operating at a loss.
Still losing money there, yeah.
BDS, Defense and Space, $6.3 billion, eked out a small profit.
Just a sliver.
But BGS, Global Services, $5.1 billion revenue, and strong profit. It really looks like services are propping up the bottom line right now.
That's a huge takeaway. The reliance on BGS for profit is, well, it's stark.
Yeah.
It really highlights how crucial that aftermarket, that support side is, especially when manufacturing is struggling. Makes you wonder if the model's shifting,
Yeah, is it becoming a services company that also builds planes?
Okay, so let's quickly run through the products. BCA, that's your 730s, the Amex variants, and 737 is delivering, but the Naga 7 and Naga 10 are still working through certification. Still in the pipeline, yeah. Development and certification hurdles there. Plus the wide bodies. 767, 7777, including the new 777X and the Dreamliner, the 787.
Then over in BDS, you've got the military side, fighter jets like the F-15, F-A-18, the P-8 patrol aircraft, the KC-46 tanker, which has had its own share of issues.
Yeah, definitely some turbulence with the Pegasus program, yeah.
And helicopters, the Apache, the Chinook, plus space stuff, satellites, missile defense, even the big SLS rocket core stage for NASA.
And they've had some recent wins there, right?
Yeah.
More Chinooks ordered, and being part of the NGAD fighter program team, that's significant for BDS stability.
Good point. And finally, BGS keeping everything running. Spare parts, maintenance, repair, overhaul, MRO, they call it, modifications, training, data, analytics.
And they just did that deal, selling off some digital stuff like Jeppesen and ForeFlight, but keeping the core digital maintenance capabilities.
Right, streamlining a bit, it seems. Now, market position, they're basically one half of the big commercial jet duopoly with Airbus.
Pretty much, yeah. The only two major players at that scale.
And the scale is just immense, about 172,000 employees at the end of last year. And the backlog, wow, end of Q1 2025, $545 billion. Over 5,600 commercial planes on order.
Huge number, but...
But yeah, the flip side, their delivery share in 2024, only around 30% compared to Airbus. That's a big drop.
That really shows the impact of the production and safety issues on their competitiveness right now. That backlog is great, but you got to deliver.
Exactly. So their value proposition used to be tech leadership, efficiency for airlines, great support. Now, it's got to be safety and quality front and center.
Non-negotiable now.
So Chapter 1 summary. They make money selling big hardware and increasingly through long-term services, but turning that massive order book into delivered safe planes is the challenge.
Absolutely critical.
Okay, let's shift gears. Chapter 2, management evaluation. Who's in charge and how are they doing?
Well, the top job now belongs to Kelly Ortberg. He came in August 8th, 2024.
Right after Dave Calhoun stepped down, Ortberg's got that Rockwell-Collins aerospace background. He's an engineer by training, which some see as a plus given the current issues.
Yeah, maybe a more hands-on engineering-focused approach. He's talked a lot about safety, quality, transparency, outlined that 4-point recovery plan on the Q1 earnings call.
And he decided to base himself in Seattle, closer to the manufacturing hub.
Which could signal wanting to be closer to the action, so to speak. His 2024 pay, partial year, was around $18 million, for context.
Now, you got to contrast that with the previous leadership, right? Calhoun, and before him, Muhlenberg, They faced a lot of criticism.
A lot of criticism, especially about maybe prioritizing shareholder returns,
Yeah.
the big buybacks, dividends, potentially over investing enough in safety and engineering.
And we can't forget the guilty plea. Boeing pleading guilty to defrauding the FAA over the original 737 MAX certification. That's serious.
Extremely serious. It points to a major breakdown in trust and ethics under past leadership. Ortberg's challenge is immense, not just fixing operations, but rebuilding that fundamental trust.
So how have they handled crises? The 737 MAX groundings, 2019-2020? The initial response was widely seen as, well, inadequate.
Slow, not transparent enough, maybe downplaying the MCS issues. The cost was enormous, financially and reputationally. We're talking roughly $20 billion direct costs plus canceled orders.
Then, bam, January 2024, Alaska Airlines Flight 1282, door plug blows out.
Reignited all the scrutiny, groundings, the FAA capping production investigations, and ultimately led to Calhoun's exit.
Since then, they've been pushing this safety and quality plan. Alaska Airlines is doing more oversight too, but the NTSB wasn't happy initially, right? Criticized Boeing for not cooperating enough at first.
Yeah, that initial lack of cooperation drew sharp criticism from the NTSB. Under Ortberg, we are seeing perhaps more public updates, employee town halls, even releasing survey results. Seems like a step toward more transparency.
But the ethical reputation, it's taken a massive hit. Perception was financial targets trumped safety. They have governance structure, sure, but demonstrating ethical behavior consistently, that's the key.
And the ongoing lawsuits, the Barnett family case, passenger suits, they keep those past failures very much in the public eye. Rebuilding that reputation is a long haul. Actions, not just words.
So the big questions. Is management honest? Capable? Focused correctly? Honesty? Well, the Max history creates baggage. Ortberg's pushing transparency, but trust takes time.
A lot of time and consistent proof.
Capability. Ortberg's background looks relevant, but turning the ship around, monumental task. We'll see the proof in the results.
Execution is everything now.
And focus. Clearly shifted from the big buyback era. Now it's operational stabilization. Seems like the right priority, but long-term shareholder value still depends on fixing the core safety and quality issues.
Which brings us to culture. You can change leaders, change processes, but if that deep-down culture doesn't put safety first,
it won't stick. And those employee surveys showing morale issues, that's a warning sign. Good that the FAA and leadership acknowledge the need for culture change, but doing it, that's tough.
It's arguably the hardest part, but absolutely fundamental. Without it, everything else is built on shaky ground.
Okay, what about capital allocation? Where's the money going?
Right now, it looks very defensive, focused on stabilizing things. So money into safety systems, the quality plan, training, fixing manufacturing processes.
R&D seems focused on existing programs, maybe not huge bets on brand new stuff because of the debt and negative cash flow.
Likely constrained, yeah. Big new clean sheet designs seem further off. Now, M&A is interesting. They just agreed to sell the Digital Aviation Solutions unit.
For a big chunk of change, right? Like $10.55 billion.
Exactly. Seems aimed at focusing on the core aerospace stuff and, crucially, maybe paying down some of that debt.
And then there's the talk about buying back Spirit Aerosystems, their old unit, key supplier.
Which could help get control over quality and supply chain issues, definitely. But integrations like that are complex, risky, and cost money, too.
We should remember the history here, too. The buybacks, huge amounts, like $43.5 billion between 2013 and 2019.
And heavily criticized, as we mentioned, for potentially diverting funds from needed investments.
Dividends. Gone since March 2020.
And unlikely to return anytime soon, given the financials and maybe even restrictions if they ever needed government help again.
So capital allocation is defensive, fix the core, maybe use the asset sale for debt, reacquiring Spirit? That's a big strategic question mark.
It really highlights the tension. Need cash to fix things and pay debt, but also need to invest. Tough balancing act.
And finally, return on invested capital, ROIC. The numbers are not good.
Consistently negative, yeah. Some reports had negative 51% for the last quarter of 24, deeply negative territory.
Meaning they're just not generating good returns on the money tied up in the business. Return on equity is kind of meaningless too, because equity's negative.
Right. Negative equity makes ROE unreliable.
So wrapping up Chapter 2. Capital allocation is defensive, focused on survival and stabilization. Success hinges on the turnaround plan working. And they have this core dilemma. Pay down debt, or reinvest, or somehow both.
That's the tightrope Ortberg has to walk. Critical decisions ahead.
All right, Chapter 3, financial health. Let's get into the numbers as of late April 2025. Market cap's around, what, 128, $129 billion.
Somewhere in that ballpark, yeah. Reflects the market's nervousness for sure.
PE ratio, negative. They're not profitable on a trailing basis. You might see a positive forward PE, but that's based on forecast.
Which are pretty speculative at this point, given all the uncertainty.
Revenue growth over 5 years, all over the place. Recovery in 23, then down again in 24. Q1 25 saw growth year over year, up 18%, but still below pre-crisis peaks.
The whole industry growth rate has slowed down a bit, too.
Profit margins, badly damaged. Q1 25 improved slightly, but still weak overall. BCA, remember, still loss-making. Full year 2024 was deeply negative. Negative return on assets, too.
Not efficiently using assets to make profit, basically.
Debt to equity doesn't really apply because of the negative equity, but the total debt number itself, that's huge. $53.6 billion end of Q1 25, maybe even higher more recently.
Yeah, north of $50 billion, a very significant debt load.
And free cash flow, consistently negative, burning cash. Q1 25, negative $2.3 billion. Full year 2024, operating cash flow was negative $12.1 billion. That's a serious cash drain.
Which directly impacts their ability to invest and pay down that debt. Very concerning.
Price to book, also meaningless, negative book value per share. So, the snapshot. Unprofitable, weak balance sheet, high debt, shareholder deficit, significant financial strain.
It's a tough financial picture, no doubt about it.
Okay, digging deeper into financial stability. Earnings consistency,
Right.
non-existent over the last 5 years. Huge losses 2019 to 2024, peaking at $11.8 billion loss in 24.
Q1 25 loss was smaller, but no clear positive trend yet. And analysts keep trimming those 2025 forecasts.
Dividend stability, zero. Suspended since March 2020, unlikely to return soon.
Debt management. It's a major focus. That $53.6 billion debt figure, up from end of 23, big payments coming due in the next few years. High interest costs $2.7 billion in 2024.
Credit ratings downgraded too. Management says they want investment grade back. That asset sale money seems earmarked for debt.
And they got that $10 billion credit line back in October 24 for some breathing room. But the interest coverage ratio is negative. Earnings aren't covering interest payments.
Working capital. Efficiency isn't great. Working capital shot up in 24 because inventory ballooned to nearly $88 billion.
$88 billion in inventory. That's massive.
Current ratio improved a bit, but the quick ratio is really low, like 0.35, means they rely heavily on selling that inventory to meet short-term bills. Inventory turnover is poor, too.
That inventory overhang is a huge risk and drag. They desperately need to convert that into cash by delivering planes.
So, summing up Chapter 3, volatile earnings, way too much debt, signals significant financial instability. That huge inventory balance is a major risk factor. Need to get production moving and sell those planes.
Absolutely. Improving operations to generate cash and manage that debt is paramount for stability.
We've hit a lot in this first half, the business, the management, the shaky financials. When we return, we'll look at what the market thinks, who owns Boeing, the big risks, especially those tariffs, and try to wrap it all up.
Sounds good.
Stick with us. And hey, if you're finding this useful, do subscribe to the Stock Analytics YouTube channel. All the sources we're using are linked in the description. We'll be right back after a short break. And we're back, diving deep into Boeing. We covered the business, management, and financials. Now, Chapter 4, market sentiment. What's the vibe out there?
It's complicated. Generally cautious, maybe leaning negative overall. That huge stock price range we mentioned earlier really sums up the uncertainty.
Yeah, investors just don't seem sure which way things are headed. There's some hope pinned on Ortberg, the new CEO.
But it's definitely balanced against all the ongoing worries about safety, quality, and, well, the financials we just talked about.
Yeah.
Volatility is the name of the game.
So, recent news. How has that played? Q1 earnings late April. Bit of cautious optimism. Loss wasn't as bad as feared. Deliveries were up slightly.
Yeah, initial stock bump. But then reality bites still burning cash, and those tariff worries started creeping in.
The asset sale announcement just before earnings, that seemed to go down okay.
Generally seen as positive. Streamlining, focusing on the core, potential debt reduction. Makes sense strategically.
But the 2025 U.S. tariffs, that's a big cloud, isn't it? Lots of negative sentiment, uncertainty about costs, competitiveness.
Definitely a major headwind the market is trying to price in. And any news on safety, quality, culture, the market is watching like a hawk.
Positive steps needed there to build confidence, but every positive seems juxtaposed with reminders of past problems.
Yeah, production rates too, especially for the 737MX. Any sign of stable or increasing production, getting towards that FAA cap and beyond, is seen as vital.
So each news item shifts the narrative slightly. Earnings offer a glimpse of hope, tariffs temper it, asset sale helps the balance sheet. Safety news is fundamental.
It's a constant reevaluation by the market based on these fragmented pieces of information. Investors want sustained good news.
What about the pros? Analyst opinions, Chapter 4.2. Sounds like they're all over the map, too.
Pretty much. The consensus might say moderate buy, but that hides a lot of holds and even sells. Significant reservations remain.
And the price targets reflect that. Big spread.
Huge dispersion. Average might imply some upside, maybe around $194. But the range is wide, like $140 on the low end up to $220.
You've got firms like Wells Fargo sticking with a sell rating, low targets.
While others, like Melius, Barclays, have seen enough to upgrade recently. Argus and North Coast went the other way with downgrades. It just shows how differently analysts are weighing the risks and potential rewards.
That lack of consensus really tells the story of uncertainty, doesn't it?
Absolutely. No clear agreement on the path forward.
Okay, last part of this chapter. Short interest and options. Are people betting heavily against Boeing?
Actually, the short interest is relatively modest, around 2.3% to 2.5% of the float, below average for similar companies.
So not a massive crowd betting on a collapse. Number of shares short is around 17 million, maybe decreased slightly. Days to cover is low, too.
Right. Doesn't suggest overwhelming bearishness from the short-selling community. Options activity, though, that's been higher.
More calls than puts being traded, like a 2-to-1 ratio.
Yeah, call-put ratio has been high, suggesting maybe bullish bets or perhaps just bets on volatility itself.
Yeah.
Implied volatility around earnings was elevated, as you'd expect.
You need to be careful just reading call volume as bullish.
Right.
Could be hedging or other strategies.
Exactly. But taken together, the low short interest and the options activity suggest maybe. Not intense pessimism, but definitely an expectation of continued price swings and uncertainty. No clear bearish consensus, but lots of anticipation.
Okay, good perspective. Let's move to Chapter 5, ownership structure. Who holds the keys?
Well, institutions dominate. About 75.5% of the shares are held by big institutional investors.
The usual suspects,
Right.
Vanguard, BlackRock.
Vanguard, BlackRock, Capital Research, State Street, Newport Trust, Fidelity. They all hold significant chunks.
Interesting that some of them added shares in late 2024.
Yeah, some notable buying from major holders, suggesting at least some long-term confidence, or perhaps seeing value at those levels.
What about insiders, management, and the board?
Very low ownership, like less than 0.1%. Recent activities mostly stock awards, part of compensation. Few small open market sales, but no big buys from top execs reported.
So ownership is pretty concentrated among the top institutions. Top 10 hold over 40%.
That's right. Significant concentration, which means those institutions potentially have a lot of influence.
Which leads right into corporate governance impact. How does that ownership translate to influence?
Well, the board itself has diverse backgrounds. Former CEOs, finance, military. They have an independent board chair, Stephen Mollenkopf, former Qualcomm CEO. Ortberg's on the board, too.
And they have specific committees, right? Including that critical aerospace safety committee.
Absolutely. Plus audit, compensation, finance, governance, and public policy, special programs. Formal policies are there, too. Ethics code, insider trading rules, clawback policy.
But the real power comes from those big shareholders.
With that level of ownership, yes. They have significant voting power on exec pay, board nominations, strategy, and ESG factors. Environmental, social, governance are huge now.
So pressure on safety, quality, governance from those big investors.
Definitely. Even the big passive managers like Vanguard and BlackRock are increasingly active on ESG. And the active managers have even more leeway to push for change. Boeing's leadership has to listen to them.
So concentrated ownership means accountability, potentially pressure for change, especially on those critical safety and governance issues.
Exactly. They're under scrutiny from their largest owners who have the power to demand action.
Okay, Chapter 6, risk assessment. Let's start with the SWOT analysis, strengths, weaknesses, opportunities, threats.
Right. Strengths. That duopoly position, huge backlog, diversified business, especially strong services, global reach, tech know-how, solid defense portfolio.
Weaknesses. Damaged reputation, ongoing manufacturing quality problems, weak financials, debt, cash burn, culture issues, program delays, supply risks.
Opportunities. Long-term air travel growth expected, fleet replacement needs, growth in services, defense spending, potential turnaround success, cash from asset sale.
And threats. Intense competition from Airbus, maybe China long-term, increased regulation, economic downturns hitting travel, geopolitical risks, those new U.S. tariffs, supply chain chaos, labor issues, rising interest rates, cyber risks, a long list.
It really lays out the battleground. Significant strengths, but wow, the weaknesses and threats are substantial right now. Execution risk is high.
Let's zoom in on those 2025 U.S. tariffs. This feels like a big external shock.
It is. Broad 10% baseline tariff, higher on some things like steel, aluminum. Aerospace wasn't heavily tariffed before, so this is new territory.
And it hits their costs directly because they source parts globally.
Absolutely. EU, Canada, Mexico, China, India. Importing components just got more expensive. Suppliers are feeling it too. Industry estimates run into billions in extra cost annually. Boeing management acknowledged the hit, especially on wide bodies.
Does it hurt their competitiveness versus Airbus?
Potentially, yeah. Higher costs might mean higher prices. Plus, the risk of retaliatory tariffs on U.S. exports is real. Boeing sells most planes internationally. Could even impact access to markets like China.
So it could force supply chain changes, more delays, squeeze already tight margins.
All of the above. Reshoring or shifting supply chains is slow, expensive. It adds pressure on cash flow, might even take resources from R&D.
What are they doing about it? Lobbying?
Lobbying for exemptions, trying to optimize using foreign trade zones, maybe price adjustments, cost-cutting internally. Management says they're managing it, but expect it to be an ongoing headache.
So the tariffs basically amplify all their existing problems. Strained supply chain, unstable production, weak financials. Makes the turnaround harder.
Precisely. It's an external shock hitting them right when they're most vulnerable. Increases the overall risk significantly.
Okay, pulling it all together. Chapter 7. Conclusion. What's the bottom line?
Boeing has enduring strengths, market position, technology. But they're currently buried under massive challenges. Operational, reputational, financial.
Ortberg's turnaround is happening. Some early signs, but execution risk is sky high. Financials are still really shaky, lots of debt, negative cash flow.
Market sentiment reflects this cautious, divided analysts. Big institutions own a lot, giving them potential clout, and those tariffs are a major external threat layered on top.
Trying to figure out what Boeing is really worth, its intrinsic value, seems almost impossible right now.
Extremely difficult. Standard metrics don't work well. Forecasting future cash flow feels like pure guesswork with so many unknowns.
So looking through a value investing lens, understandable business, yes, but economics unfavorable right now, moat compromised. Able and trustworthy management. Trust needs rebuilding, execution unproven. Sensible price tag. Margin of safety looks very questionable given the risks.
That qualitative assessment lines up. Too many uncertainties for a confident value judgment right now.
So the conclusion from that perspective. High-risk investment. Strategic assets are there, but overshadowed by crises and tariffs. No clear visibility, substantial risks mean margin of safety is uncertain.
Investors probably need to see clear, sustained proof of operational improvement and maybe a bigger discount before jumping in. Significant caution is warranted.
The potential is there, but the path is treacherous. No guarantees.
Exactly.
Which brings us to our final thought, our end hook for you to consider. Given the sheer scale and complexity of Boeing's problems, plus these new trade headwinds, what single factor do you think will ultimately decide its success or failure?
That's a tough one. Lots to weigh there.
Something to mull over. And if this deep dive helped you understand the complexities, please subscribe to the Stock Analytics AI YouTube channel. More analysis like this there. All our research sources are linked right in the description below.
And just a reminder, this discussion is based on research and AI assistance. It's for informational purposes only, and definitely not financial advice. Please do your own homework.
So to quickly recap, Boeing faces immense hurdles, operational, financial, reputational, now trade pressures too. It's a complex turnaround story.
Success will hinge on consistent execution, on safety, quality, efficiency, and navigating this tricky global environment.
We hope this gave you a solid foundation for your own thinking. Thanks so much for joining us for this deep dive.